Matt Jensen, welcome to the show.
Thanks for having me, Brian. Glad to be here.
Yes. All right. Before we dig in, let me read my disclosure, as I always do. eWealth Partners is an investment advisor registered with the state of Minnesota. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. Determine what strategies or investments may be suitable for you and consult the appropriate qualified professionals prior to making a final decision. All right, Matt. So we're going to be talking about estate planning today, more targeted and geared towards estate planning considerations for business owners. But before we actually talk about estate planning, let's first even just define estate tax. And what we're trying to do with estate planning is hopefully minimize, if not avoid, estate tax. So I don't know. How do you define even just estate tax?
No, great question, Brian. And I deal with this a lot with my estate planning and tax practice here in Minnesota. And the goal and purpose of estate planning is generally to make sure we direct our assets to our spouse, to our children, to our beneficiaries as we see fit. Estate planning 101 goal is make sure our plan passes our assets as we want. A very close second, or a 1B, is estate taxes. And what does that look like? And generally, how can we avoid them? So I'll just jump right in. Here in
Yeah.
Minnesota, we are subject to two different estate taxes. Here in Minnesota, we have a state specific estate tax in addition to the federal estate tax. And in Minnesota, we're one of about a dozen states that applies our own Minnesota estate tax. So when I'm talking about estate tax planning with my clients, I usually start with the Minnesota state tax and I just talk about who it applies to and what it is. But basically, our Minnesota estate tax applies to Minnesota residents and people with property in Minnesota. My practice is in Eden Prairie, so generally I'm dealing 99% of the times with Minnesotans, but we do have clients who are out of state. So our Minnesota estate tax, what it is it is a tax on residents and people who own property here. And basically, to simplify it as much as I can, if you've got assets over a certain threshold, the Minnesota estate tax applies. As of today, November 2024, our Minnesota estate tax exemption is $3 million per person. And if you end up over that exemption, if you end up paying that Minnesota estate tax ranges between 13 and 16%. So
Okay.
as it relates to the Minnesota estate tax, I'm telling my clients, if we've got a total estate, if I'm working with a couple and they've got assets in excess of 3 million bucks, we need to incorporate some kind of tax planning such that I can capture as much as or all of spouse A's $3 million exemption and as much as we can for spouse B's $3 million exemption.
Okay. And before we dig into that, you did say that Minnesota is one of like 12 states that has an estate tax.
Correct. I am only licensed in Minnesota, so I deal with our estate tax.
Yeah.
So I can't speak from an educated perspective on every other state, but
Right.
just to put it broadly, I mean, some states charge an inheritance tax, some have an estate tax. Generally speaking, the estate tax in my mind that states apply, it is, whether the estate pays it or the beneficiaries pay it, that's the tax I'm referring to. And
Sure.
Minnesota is one of about those dozen who applies that separate state specific tax in addition to the Fed.
So if you're a Minnesota resident, we have a net worth over 3 million, we potentially may be subject to a state tax. And what was that years ago? It was a lot lower, wasn't it, the Minnesota state tax?
You're right. So if we go back to 2013, the Minnesota exemption amount was $1 million per person. So back in 2013, that Minnesota exemption, that estate tax applied to a lot more people. Between 2013 and 2020, that Minnesota exemption amount gradually crept up. Started at 1 million back in 2013. By the time we got to 2020, it reached $3 million and it has stayed at $3 million. And it will stay there until we see something new come out of the legislature and our representatives in St. Paul.
So if we're talking, to a general audience of business owners, there's a decent chance that their business alone could be over 3 million. And so now we have some illiquidity problems too, which is probably a whole nother conversation. But talk through maybe just some considerations as a business owner, as in a resident of Minnesota. And maybe here's another kind of question is if you're a non-resident, but you still own a business in Minnesota, that could impact it as well. I know that probably takes us down into a whole nother topic, but just maybe any general, just things to consideration. Because I know, like, well, what if I move my residence down to Florida, but you still have the business primarily based in Minnesota? That's still something we need to consider.
That's a lot to unpack there. I'm going to start at
Yes,
the
all right.
beginning. No worries. And just talk about how it applies for our business owners. And our firm, we were founded as a small to mid-sized firm to deal with businesses. So a lot of our clients are in that circumstance where we've got a business and that's the client's primary asset. So when we're talking about the Minnesota state tax, one of the important things to remember is each spouse has their own estate tax exemption of $3 million. But that doesn't automatically mean every married couple gets $3 million of exemption. So if I'm working with a business owner and they've got a business worth $8 million and a home worth 500,000 and a net worth of 9 million total, the business is obviously the big chunk of that. But what we need to look at is how could we structure their estate such that if the non-business owner dies first, we can still potentially capture some of that exemption. So what I'm talking about there is with a lot of married couples, the default planning goal would be if I die, give it all to my spouse. If my spouse dies, give it all to my kids. I hear that every day. However, if I die and I just leave everything straight to my spouse, it doesn't matter if I leave my spouse $100,000 or $10 million. You can leave whatever you want to a spouse, and that's all estate tax free. The issue becomes what happens when my spouse dies? What if she's sitting on a full $10 million estate and her exemption only covers $3 million because that's the Minnesota estate tax exemption? So for a lot of our business owners, we're working with them to try to figure out, all right, each of you has this $3 million exemption, but what can we do to try to capture both of those exemptions? And so for a lot of our business owner clients, that may mean we look at, depending on what the business is and how things shake out, it could mean shifting a business interest to a spouse. It could mean that if the business owner spouse has all of the assets on their side of the ledger in their name or their trust, we may look to shift other assets, investment accounts, real estate, cabins, homes, things like that into the other spouses. But probably the biggest issue I see with the Minnesota estate tax is people mistakenly think that, oh, I'm married, we'll get 2 million, we'll get two exemptions at 3 million a piece. So I'm only going to have to pay what's over 6 million. But I'm telling my clients, hey, we've got to address this so we can capture both spouses' $3 million exemption.
And so, but by addressing it is making sure, ideally, if we can, to get 3 million in the, let's say, the non-business owners in their name. And from my side as a financial planner wealth advisor, it's okay, do we have some taxable brokerage accounts? Do we have real estate, primary residence to second property to cabin? And that's one way to, maybe you're not going to get equal between the two spouses, but at least let's try to, in that example, if we're worth 9 million in total, how can we get 3 million in the non-business owner spouse's name? Is that a fair way to say it? Okay.
You're spot on. And for some of our clients who don't have enough assets outside the business, it may look at a shift in business ownership. And that's where we're bringing in the advising team, the accounting team, and saying, hey, we've got a business owner, we've got a $7-8 million business. What does it look like if we transferred 20% of this business into the name of the non-business owner spouse? Moving some assets around like that, we've always got to be careful with what agreements or documentation or tax planning or structuring that can impact. But
Right.
For some of our clients, that is an option.
Okay. And that's probably another topic for another day is what are the considerations on that piece as far as, voting shares to maybe like a family limited partnership to discount shares, but we'll keep that topic for another day. All right. Anything else we should be aware of or consider on the Minnesota side before we go into the federal estate
I'd
tax?
say that probably the last thing I like to talk about with the Minnesota estate tax is just how it applies, because it applies in a different way than the federal estate tax. So the way Minnesota applies our estate tax is we take a snapshot of the deceased individual's total net worth, and then we look at any large gifts made within the past 3 years. So what's interesting about Minnesota is if I gift away assets to my children or to other beneficiaries, and I live 3 more years, in all likelihood, those previously gifted assets will not count as part of my estate when Minnesota estate tax applies. So the big takeaways in my mind for the Minnesota estate tax are, first of all, not every couple is guaranteed two exemptions. Each spouse gets a $3 million exemption. And if we plan properly, we can potentially capture both $3 million exemptions. And then the second big thing is Minnesota takes a snapshot at death with a look back of 3 years as it relates to gifting. So that's the things I like to hit for the Minnesota estate tax.
Yeah, the 3 year look back is the 3 year look back 3 years from date of death, or do they look at tax years, calendar years, or is it date of death?
Understanding is 3 years from date of death. And then the other question I get about this is people say, well, what about the 5 year look back? I've heard about the 5 year look back. That relates to medical assistance planning and trying to shift
Oh,
assets out. So 3 years for gifting with the estate tax, but this 5 year rule we have is completely separate, and that only relates to medical assistance planning. So I just want to address that because I have people who think that the 5 year look back applies to the estate tax. And I say, no, the estate tax is 3, but medical assistance planning is 5.
yeah, that's a good clarifying point because I get that question myself. All right, now let's move on to federal estate taxes, and we got some potential changes coming up. Who knows? So talk us through that.
Yeah, absolutely. So the federal estate tax applies to everyone in the US, regardless of what state you live. So if you live in Minnesota, we have the Minnesota estate tax and the federal estate tax. They are two separate taxes and they can stack on top of each other. So it's not if I pay the Minnesota, that reduces my Fed. We pay the federal estate tax. And you're right, we have had activity as it relates to the federal estate tax exemption. And this kind of tracks back to 2017. So if we go all the way back to 2017, our federal estate tax exemption at that time was approximately 5.5 million per person. Now with the federal estate tax is what we call portable, meaning every married couple gets two exemptions. If I die, my wife can file a federal return and she can take my unused federal estate tax exemption. She can port it over to herself. That's what we mean by portable. So the federal estate tax, I know every married couple gets two exemptions. So if we go back to 2017, the exemption was 5.5 million, technically 5.49 million per person. But then in 2017, we had the Tax Cuts and Jobs Act under President Trump at the time, which doubled the exemption amount. So in 2017, the exemption was 5.5 million. In 2018, that exemption jumped to about 11.2 million. And I say doubled, but the numbers never match up because there's always these inflation adjustments.
Yeah.
So we had a doubling of the federal exemption, but back at the time, that doubling provision was set to sunset out come end of 2025. So we had a double from 2017 to 18. From 2018 till today, the exemption has just kept creeping up for inflation to where now our federal exemption is 13.6 million per person. So every married couple can pass on $27 million plus of assets without paying any federal estate tax. So what people in my industry have been talking about now for probably the last 2-3 years is this pending sunset of that exemption. Because under current law, come January 1 of 2026, our exemption is going to get cut in half. So it's going to go from 13.6, it'll drop back down to whatever inflation adjusted number that is, but maybe $7 million. So that's what people in my industry have been planning for. And for the last few years, what we had recently was an election, and Trump got reelected. And one of his campaign promises was, or campaign statements, was to say, I'm going to extend these tax cuts. So there's a lot of wealthy individuals, a lot of tax planners, a lot of attorneys who are now thinking, all right, maybe that sunset, maybe that cut in half of the exemption come 2026 isn't going to happen because we'll have a prolonged extension of these tax cuts.
And we would need Congress to pass that through the channels, House and Senate, and it's looking looking like a Republican control in all of them. So I don't know if we would, place our bets, but it's looking a lot more likely than it did probably a year ago. And when I'd have conversations with my clients, is like they do nothing or can't agree, then we know it's going to sunset. So now maybe the odds are a little bit better that they would be extended, but who knows? And okay, so now if it sunsets, goes back to the old, basically that adjusted number roughly is about 7 million per spouse, 14 million. You said that's portable. So in that case, if it sunsets back, if you're under 14 million, roughly speaking, likely not subject to a federal estate tax. If they do extend it, now it's going to be that same 27 million with probably some cost of living adjustment. So to simplify, if you're below 27 million and they extend it, then we likely don't have a federal estate tax. Is that correct?
You're spot on. And so what we're seeing with a lot of our clients is we've got clients who are over the Minnesota exemption. Their estate is 3 million, 6 million plus, but maybe they're under that 14 million, or maybe they're under that 26 million. Depending on where you live, if you live in a state, Wisconsin, North Dakota, South Dakota, whatever, if you live in a state that doesn't have a state-specific estate tax, estate planning is a lot easier. For my business owners in Wisconsin, all they worry about really is the federal estate tax at their death. And if the exemption stays at 26, 27 million plus, anything under that, they're going to be fine.
Sure. Okay.
So a lot of excitement on the federal estate tax side of things, which is frankly about as much excitement as we get in the estate and tax planning realm.
All right. So now let's talk through some estate planning considerations. We defined and talked through the estate tax. So what are we doing? What are we doing with our own estate plan to help maybe minimize the estate tax piece of it? I mean, there's other strong reasons why you obviously would get an estate plan and those documents in order just to get things orderly. But let's talk through maybe some of what business owners, what makes sense for them to create here in Minnesota specifically. So why don't you what are some considerations business owners should take if they're a Minnesota resident?
Yeah, I'd say there's two things. The big one you already hit, which is just having planning in place. The second is, what do we look like and what does planning look like as it relates to the Minnesota estate tax? So for my business owners, I say the first thing, just the starting point, is we have to at least think about or talk about what you want to have happen with your business. We work with a variety of business owners. It may be the one person consulting shop who does $50,000 in revenue a year. And when they're gone, there is no consulting business because the consultant is now also gone. We work with those kind of clients, but we also work with the fourth generation business owner, and we're trying to figure out how to pass it to the fifth generation. But I don't think I can ever recall a single instance where simply ignoring the business interest with your estate planning really works out well. Even if it's something simple where we say, all right, when I'm gone, wrap up the business, close down the LLC and empty out the bank account. Just talking about it on the front end is essential to what we're doing on the estate planning side. And I have a lot of business owners where you get busy. You've got life, kids, families, your business to run. Nobody wants to sit down and spend hours talking about their own mortality and what's going to happen with their business when they're gone. Because a lot of my business owners are thinking about, how do I expand the business? What's payroll look like? All these other things. So just sitting down at the table and talking about it is the first step. And you and I've had these discussions, Brian, we sit down with our clients and say, hey, what do you actually want to have happen with your business? And I have a lot of business owners where they just aren't sure, but just asking that question can kind of help prompt some discussion to figure out where we want to go with this.
Okay.
So that's the first thing. As I say, we have to talk about it. Once we talk about it, then we talk about, all right, what does this mean for your actual estate plan? Do we need to build a provision in? I don't want to go too far into the whole, what's the difference between a will and a revocable trust? And I don't want this to be estate planning 101. Yeah. But I do talk to my clients about, hey, if we're going to have a will-based estate plan and my estate goes through the probate process when I'm gone, what does that look like for the continuity of my business? Is there anybody who can step in? Will somebody have authority to act on behalf of my business? If I've got an estate plan structured around a revocable trust and I pass away, my successor trustee can step in and we're going to have more immediate access and control to the assets of my trust, which can include my business. So, in terms of how do we build an estate plan, I don't think that's the topic for today, but these are the discussions I'm having with my clients about, all right, if you're gone, who steps in with the business? What does this look like? And is a prolonged probate proceeding something that our business can tolerate? Or should we look at revocable trust planning so that we have someone who can step in and act more immediately on our behalf?
And what's important to remember with revocable trust planning, sometimes I think we get paralyzed with the idea of who would we name? It's better to name someone, obviously, and just to know that you can always update that. You can always change that in time, right?
You're spot on. And so when I have a client who has a revocable trust-based plan, we generally are going to assign business interests to that revocable trust. During that business owner's life, they still fully own and control their own trust. They own and control their own business. The benefit, and it is what it is. People pass away, business owners die. If I pass away and I've got my business in my revocable trust, if my wife is my successor trustee, she can step in and she can act on behalf of my trust and my business. That may mean appointing a co-trustee who can help with my business. That may mean working with my pre-established advising team to figure out a course to immediately sell the business. We never want to see a business fire sold or anything like that, but there are some businesses out there where the longer you wait to sell a business, the less value your business has. And
right.
So having someone with that authority in short order can actually preserve the value of the business. But no, just building out that structure of, hey, here's someone who can do something is pretty essential for a lot of our business owners.
Yeah, and you mentioned assigning the business to the trust. That is often overlooked. A business, or even just we'll say these LLCs that you didn't think much of, and then all of a sudden you got one or two different assets in there. But just the assignment piece is often overlooked. And if it's not, is it fair to say if it's not assigned, that business or LLC is not assigned to the trust, then it's not in the trust.
Correct. And this gets back to just kind of the basics of estate planning. If I've got a revocable trust, I better have my stuff in my revocable trust. And for my business owner clients, that's just making sure that we assign our interests to that trust. I'll give you an example. I had a business owner client pass earlier this year, and he owned 50% of a business with his brother. My client had assigned his 50% interest to his revocable trust. My client and his brother, they had a buy-sell agreement in place. So when my client passed, his brother bought him out. What that meant is his brother purchased my deceased client's interest from his revocable trust. Cash went back into the deceased client's revocable trust, and it was there for his spouse. But having that interest in trust allowed us to work through that buyout without having the probate court get involved as part of that process. So this is something I repeatedly tell my business owner clients is implementing this revocable trust, assigning interests to our revocable trust we're not trying to have you give up control or change how you operate your business. We're just trying to set the stage for what happens if, you do pass away owning this interest.
And then you can assign the business to the trust. So now it's been assigned. You still can modify, change the trustees, the rules of the trust, all of that. That's like a separate thing. But first, we have to make sure we assign it. And then if we ever need to make changes to that trust, which you can irrevocable, that can be done. So that's good to point out. What are some maybe, again, this is probably another topic that we dive deep into, but by doing this, maybe at a high level, how does this help minimize the estate tax? Just it's probably more basics like 101. What is it actually doing? And whatever the short answer is, well, we're getting it out of the taxable estate. But can you just shed some light on that? What's the mechanisms within the trust that's allowing for it to now be removed from their taxable estate?
With business interests and revocable trust planning, I tell people when I'm talking estate tax planning, I generally will disregard whether something is a business or whether something is real estate or whether it's a brokerage account. If I've got a business worth $5 million, or I've got real estate worth $5 million, or I've got just a brokerage account with my advisor worth 5 million, that's 5 million of value that at my death we need to plan for. And as I mentioned earlier, if I've got a married couple and we've got $3 million of exemption, one thing we need to do for our business owners is figure out the best way to capture some of each spouse's exemption or all of each spouse's exemption. Whether that means retitling a business, sorry, not retitling a business, but shifting an ownership interest to a spouse, whether it's a $5 million business that we're shifting into non-owner spouse's name or non-owner spouse's trust, or whether it's real estate, we are just trying to balance things out so that we can capture $3 million of exemption. What I don't want to happen is I don't want that business owner to pass away and just leave 100% of that business straight to their spouse, because while that's simple, it's not efficient from an estate tax perspective.
Yeah, basically, there's a mechanism within the estate plan through these trusts that can move that asset outside of the taxable estate of the surviving spouse, or some of that, right? That doesn't necessarily mean that surviving spouse can't live off of some of that income and get into the principal. Again, that's probably a whole nother topic of just how those operate. But really, what's important to remember is it's a way to get some of the assets out of the taxable estate by doing proper estate planning and using trust. And if we don't do the work, then it's, again, in Minnesota, the key thing to remember is that we lose that portability. So if we don't have that in place, we're essentially losing out on $3 million worth of portability. And you take that at the Minnesota estate tax rate, like that can be hundreds of thousands, depending on how large your estate is, correct?
You're spot on. And if we lose out on a $3 million exemption at a 15% estate tax rate, that's $450,000. So that's a pretty big whoops. So I tell my clients, we plan for this preemptively, and I don't want to go too deep into the logistics of it, but really what it looks like is, say I've got an estate plan in place and I've got a $6 million business. My estate plan can say, when I die, we take $3 million of my assets and we direct it to a separate trust where my wife is the trustee and my wife and kids can be the beneficiary. By allocating that $3 million to a separate trust for my spouse, that in Minnesota is how I capture my exemption. So I'm not giving all $6 million straight to my spouse. I'm saying, all right, let's hold $3 million in a separate trust for my spouse and kids. Everything else can go to my spouse. It's that carve out of the $3 million that captures my exemption at death. So my spouse could have access to that trust. She can get the income from it. She can use the principal of it. But by carving off that $3 million, that's how we capture exemption in Minnesota. And I don't want to give a history of the federal estate tax, but this kind of planning used to be done at the federal level as well. But since the federal estate tax is now portable and married couples get two exemptions, we don't do this kind of planning as much on the federal side. But since Minnesota's estate tax is not portable, we do a lot more of this kind of carve out or bypass trust planning because it's frankly just a very efficient way to capture Minnesota estate tax exemption upon the death of a spouse.
And the trusts are usually written, right, where if that exemption moves from 3 million to 4 million or down to 2 million to 1 million, you don't have to, you know, update it. Usually it's written to say whatever the exemption is for Minnesota type of thing. So they're okay there. That doesn't need to be updated, anytime they move that exemption level. And then also too, if you're a growing family and you want to leave it to your kids or grandkids type of thing, that can also be written just into the estate planning documents too. So like that shouldn't be the piece that is paralyzing you not to do the work because they can be written with a little bit of, I'll say, freedom of future, like I said, kids, grandkids. And if the exemption laws change here in Minnesota or even on the federal side, you don't have to necessarily go back and update the trust.
You're correct. Yeah, the documents we're preparing, we're not saying allocate exactly $3 million. The language of the planning document is basically a formula saying allocate as much as we can to such that there would be no estate or federal taxes owed. But one thing I did want to comment on, Brian's, you mentioned the young families, and it's young families, it's old families, it's people who don't think they're wealthy. I tell people we still need to talk about estate tax planning. A lot of young families, there's a lot of Minnesotans who don't have a $3 million net worth today. And they say, okay, great. I don't need to talk about estate tax planning. But what if your business grows? What if you have life insurance in place? What if an inheritance happens? I don't see it as often today as we did 10 or 11 years ago, but back in 2013, 2014, when our Minnesota estate tax exemption was at 1 million and 1.2 million, we dealt with families where they say, mom died, and now you're telling me we have to pay an estate tax? I said, yeah, apparently mom was a saver. She had a fully paid off home. She had large IRAs, and mom passed away with $1.5 million of net worth. And they said, mom wasn't wealthy. I said, it doesn't really matter what you think of wealth or not. Minnesota at that time said, if you've got an estate of more than $1 million, here's our Minnesota estate tax. So part of this discussion around estate planning is telling people like, hey, these things can sneak up on you, even if you don't think of yourself as wealthy. We have a lot of people who are over that exemption amount without even realizing it. Maybe because they have life insurance in place or things like that.
Yeah, and that kind of triggered just another piece of with business owners that have higher estates subject to estate tax. What if your business is basically makes up all of your net worth? Then we might have a liquidity problem of paying the estate tax when that's due. And working with a wealth advisor of just understanding that other than because if you don't, you may have to have somewhat of a fire sale with that business ownership to come up with the dollars to pay the estate tax. So that's a part of it too, is just looking at the liquidity, what assets are there, something that we help with. And all right, so let's close up here and the other thing I actually want to say too is we talk about these documents and it gets your stuff in order, helps minimize estate tax, but it also helps minimize the estate planning bill to the attorney. Yes, it does take some costs up front, in my opinion, worth the cost. But now you have at your death or second death or whatever it is, things are much more in order, right? And if it's disorder, then we are hiring attorneys after the fact. And it's typically, in my experience, that's where it becomes much more costly is when we don't have anything in place. And so not only are we saving, hopefully done right on estate tax, but we're also likely saving on just those attorney fees too. Is that a fair statement to say?
Generally speaking, I would absolutely agree. There is almost never a time where, just ignoring it is better than planning for it, especially for our business owner clients. When we're dealing with family businesses, there can be so much emotion there. If every kid grew up in a house where mom and dad ran the business, and now mom and dad are retired, but only one kid runs the business and the other two kids don't. These situations are just fraught with issues where it leads to conflict if mom and dad don't plan properly. There are ways where we can say, all right, I want to pass the business to this child, but I want to equalize the other kids. Or I want voting control to pass to this kid, but I still want these children involved. So addressing these things on the front end, all we're going to do is hopefully reduce the potential for conflict. And for our business owner clients, it's just something we need to address to make sure that when they're gone, them leaving their kids or spouse a business doesn't tear the family apart, because unfortunately that does happen.
Yeah, let's end with this, Matt. So if someone is looking to work with an estate planning attorney like yourself, what is the typical engagement process? What does that look like in that initial year? You're drafting up documents, talking through that, and then ongoing years. Let's maybe just close with that.
Yeah, no, generally, when people are going to work with an attorney to develop an estate plan, a lot of attorneys in my practice out there will do the consultation, the free discussion, and just talk through what this can look like. People have varying degrees of expectations as to what things are. If you're talking to the person who says, I can do this on LegalZoom for $300, the odds that they want to engage in comprehensive planning, probably not super high. So first, it's just working with an attorney who understands what we're trying to accomplish here. And then procedurally, I have clients who come in, they've thought about everything, they've made every decision, and things are done in a matter of weeks. The normal timeline, probably closer to anywhere from 2 months to 3 months, maybe 2 months to 4 months, from that initial discussion to having a couple meetings or phone calls and actually getting documents signed. For most of our clients, I would be thrilled if they thought about their estate plan every 5 years. But I tell my business owner clients, we probably need to think about this more frequently, because as your business changes, as things evolve, as kids or family members come in or out of the business, we may have to adapt our estate planning. So I do have quite a few clients who own businesses where every year or two, we're sitting down, we're talking about what's new. Does this impact their estate planning? And if the changes in the business don't necessitate a change in their planning, then great, we go on our way. But if something big happens with the business and we've got our business specifically planned for within our estate plan, we need to make sure we're fluid and adapting as their business adapts as well.
Yeah, what I love just working with your, I'll say, qualified estate plan attorneys is they work with the advisor to make sure it all gets funded and aligned, and at least you have a very clear kind of checklist of what needs to happen next with maybe the assets that we're helping our clients with, the brokerage accounts, to how we should title beneficiaries on retirement accounts, to life insurance. And there's a bit of a hand holding that you do not only with the client, but also working with the advisor too. And that is extremely valuable just from my side. All right. With that, Matt, this was a great kind of, I'll even call it just an introduction to estate planning for business owners. And maybe when we have you next or another time, we talk more through kind of some of these, we'll call them advanced strategies of what to do with some of that business ownership through trust, through family limited partnerships, through SLAS, through that's a whole nother kind of advanced piece. But this was a great start. So Matt Jensen, thank you for your time.
I appreciate you having me. Really enjoyed it.